America's economy is booming. At least that's what the headlines say. The stock market hits record highs, but for most people, daily life feels harder, not easier. The truth? We're living in two economies, one for the ultra-rich, thriving on finance and tech, and another for everyone else, where wages lag and costs soar. The gap isn't a crack, it's a canyon. The booming economy is driven by a handful of giant companies, disconnected from the reality of most Americans. Meanwhile, the real economy, where people work, make things, and provide services, feels stuck, or even in decline. National numbers look strong only because of the wealth concentrated in a few states and among a tiny elite. Over the next few scenes, we'll break down who's really benefiting, how the stock market became a bubble, and what it all means for the average worker. Because when prosperity is this lopsided, the risks for everyone else grow. Let's dig in. To understand the divide in America, you have to follow the money, because money more than ever shapes who has power, security, and opportunity. The richest 10% of Americans now account for nearly half of all consumer spending. Their choices drive the economy, from luxury brands to high-end real estate, setting trends that ripple through every sector. 3 decades ago, it was just over a third. Back then, the middle class was the engine of growth, and prosperity felt more widely shared. Today, the top 10% also own nearly 90% of all stocks and mutual funds, giving them a stake in every market surge and a cushion against downturns. The bottom half of Americans? They own just 1% of the market. For them, investing is a luxury, not a reality. So when the S&P 500 soars, it's the wealthy who get richer. Everyone else is left behind, watching from the sidelines as the gap widens. The stock market's performance no longer reflects the health of the broader economy. Main Street and Wall Street have never felt further apart. Today, it's a high-stakes casino for the few, while most people struggle just to stay in the game, facing rising costs and stagnant wages. Politicians point to strong GDP and market numbers, but those stats are shaped by the fortunes of the elite, not the daily realities of most Americans. This creates a dangerous illusion of stability, masking the fragility most Americans feel. Beneath the surface, anxiety and uncertainty are growing. The gap between the asset economy and the real economy is the defining feature of our time, shaping everything from where we live to how we work. The health of the top 10% now dictates the headlines for the entire nation, even as millions feel left out of the story. But the foundation for most people is shakier than ever, and the question of who truly owns America has never been more urgent. Who's driving the stock market's wild growth? Just 7 companies: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. These tech giants are so dominant that their performance steers the entire market. As of late 2025, they made up over 30% of the S&P 500's value and drove more than half its growth. Without them, the market would be flat. This isn't a broad rally, it's a narrow surge led by a Silicon Valley elite. The risk: if even one stumbles, the whole market feels it. The US stock market is now a giant pyramid balanced on a tiny point. America's tech giants are financially larger than most countries. Investors are piling into these few stocks, convinced they can't lose. This feedback loop, money chasing money, creates the classic conditions for a bubble. The wealth of the top 10% now rests on the shoulders of these 7 giants. It's a fragile foundation. What's fueling this unprecedented surge in the markets? 2 letters: AI. Artificial intelligence has become the buzzword on everyone's lips, from Wall Street to Silicon Valley. Artificial intelligence is the new gold rush, igniting a frenzy of investment and speculation. Investors are scrambling to get a piece of the action, hoping to strike it rich before the next big breakthrough. Companies are pouring billions into AI, and investors are chasing anything with AI in its pitch. Startups are rebranding overnight just to ride the wave. The Buffett indicator, which compares the stock market's value to GDP, is now over 219%, far above the dot-com and 2008 bubbles. This is a level that has historically signaled extreme overvaluation. The hype is running ahead of reality. Expectations are sky high, but the results are lagging far behind. 95% of generative AI pilot programs are failing to deliver real returns. Many projects are still stuck in the experimental phase, burning through cash without clear paths to profitability. Even AI leaders like Sam Altman and Jeff Bezos warn we're in a bubble. Their cautionary words echo through the industry, urging restraint and realism. Companies and investors are spending out of fear of missing out, not because profits are rolling in. The pressure to keep up is driving risky decisions. Valuations are based on future dreams, not current performance. Hype and hope are outweighing hard numbers and proven results. This is classic speculative mania, a hot new technology, a compelling story, and a sense that everyone must get in now or be left behind. And a flood of easy money is fueling the fire, making the stakes even higher. The question isn't if the bubble will pop, but when and how messy it will be. History shows that such frenzies rarely end smoothly. The risks are real, and the fallout could be severe. Ordinary people, not just investors, could feel the pain if the bubble bursts. The AI boom is a high-stakes gamble, one that could reshape the economy, for better or for worse. Bubbles are fueled by human psychology, greed, fear, and herd mentality. Even professionals know stocks are overvalued, but they keep buying, hoping to cash out before the crash. It's a game of musical chairs. Everyone knows the music will stop, but no one wants to leave the party early. This isn't investing, it's speculation. People buy not for long-term value, but because they think someone else will pay more tomorrow. The AI bubble is a speculator's paradise, driven by stories, not earnings. As long as prices rise, the feedback loop silences doubters. But bubbles are unstable. They need a constant supply of new buyers. When sentiment shifts, the rush for the exits is brutal. The same herd that drove prices up will drive them down, even faster. The crash, when it comes, will be swift and painful. Want proof the market's detached from reality? Look at Tesla. At its peak, Tesla was valued at $1.4 trillion, almost as much as the entire global auto industry. In 2025, it was worth more than 15 of its biggest competitors combined, despite selling far fewer cars. Why? Investors see Tesla as a tech, AI, and energy company, not just a car maker. Its valuation is based on future breakthroughs, robotaxis, humanoid robots, not current profits. Investors are buying the story, not the balance sheet. This is bubble thinking at its purest. Tesla's stock price has become a belief system. For some, skepticism is heresy. For others, it's a sign the market's lost its mind. Tesla shows how narratives, not numbers, can drive extreme valuations. It's a powerful example of the market's speculative fever. The AI bubble isn't just a Wall Street game, it's reshaping the real economy in ways we're only beginning to understand. Tech giants are in an arms race, spending hundreds of billions on AI data centers, chips, and electricity. This massive investment is unprecedented. In 2021 signs, four companies alone will spend over $300 billion on AI, more than the GDP of many countries. This level of spending is reshaping global economic dynamics. This spending now drives almost all US GDP growth, creating a dependency on AI investments. Strip out AI, and the rest of the economy is barely growing. Traditional sectors are struggling to keep up. The surge in AI data centers is straining power grids and driving up electricity prices for everyone. This is an often overlooked consequence. Average US electricity costs have jumped from 13 to 19 cents per kilowatt hour since 2020, a significant increase. Your bill is rising, partly to fuel the AI gold rush. This affects everyday people in tangible ways. In 2025, AI investment contributed more to GDP growth than all consumer spending combined. This shift is unprecedented. The economy looks strong on paper, but it's a mirage. Growth is concentrated in a few tech giants, leaving many sectors behind. The rest of the economy is stagnating, masked by the AI spending spree. This disparity is growing. The costs are real, and they're hitting everyone else. The impact is widespread and profound. If the economy's so strong, where are the good jobs? Job growth has slowed dramatically, down 75% from last year. The Bureau of Labor Statistics had to revise its numbers, erasing nearly 1 million phantom jobs. Most new jobs are in government or health and education, not in dynamic, high-paying sectors. Manufacturing, construction, and non-elite tech aren't adding jobs at a healthy rate. The private sector is struggling to create upward mobility. Growth is concentrated in areas dependent on public spending or insurance. The real economy where most people work is sputtering. The job market tells the true story. Prosperity is not being shared. The divide is growing and it's leaving millions behind. America's economy is a house divided. The rich celebrate a historic stock market boom, powered by AI and a handful of tech giants. But for most, the real economy is stagnating. Jobs are scarce and costs keep rising. The richest 10% own nearly all the stocks, and just 7 companies drive the market. The bubble is bigger than ever, built on hype, not widespread prosperity. Bubbles always pop. The only questions are when and how much damage will follow. Ordinary families will bear the brunt, just as they did after 2000 and 2008. We must stop confusing the stock market with the nation's health. Look past the headlines. Focus on the reality for most Americans. Demand that valuations reflect real value, not just hype. Watch for warning signs. Slowing tech growth, shifting sentiment, cracks in the AI story. Navigating what's next will require clear eyes and a commitment to building an economy that works for everyone. The stakes couldn't be higher.